Usually when we look at a corporate earnings report, there is this expectation of absolute precision.
Right, yeah. Like a math test.
Exactly. It's like looking at a financial x-ray. You have your revenue line at the top, you have your expense line right there in the middle, and the profit is just sitting at the bottom, glowing in stark black and white.
It feels incredibly binary.
It really does.
Yeah.
You either made money or you didn't. The bone is either broken or it is completely intact.
And, as an investor, you take comfort in that clarity because you can make an immediate definitive judgment on the health of the patient.
Right. It is comforting because we like things to be easily categorized. But then, and this is where it gets messy, you step into the world of massive multi-billion-dollar corporate mergers, and suddenly that x-ray machine is just broken.
Completely shattered.
Yeah. We're looking at a financial landscape that is honestly incredibly murky. You have overlapping divisions, you have massive piles of debt being swallowed whole, you have entirely new business units being like Frankenstein together in real time.
Oh, it is the absolute definition of muddy accounting waters. You cannot just look at the top line revenue or the bottom line profit and actually understand what is happening inside the body of the company.
You really can't.
The surface numbers will actively deceive you if you don't know how to read the underlying mechanics.
And that is exactly why we are here today. So welcome to this Talk Tickers Deep Dive. Today, our mission is to examine the ultimate murky X-ray. We are talking about Omnicom Group. Ticker symbol is OMC.
A massive one.
Massive. We are diving deep into their Q1 2026 earnings call. And the promise here is that we are going to cut through the Wall Street jargon, we're going to hit the headline numbers, and we're going to explain what is actually driving this newly merged titan.
And we really should establish right away just how big of a deal this specific quarter is.
Yeah, set the stage for us.
So prior to this, you essentially had the big four advertising holding companies globally. You had WPP, Publicis, Omnicom, and Interpublic, which is also known as IPG.
Right. The giants of Madison Avenue.
Exactly. They controlled vast swaths of the world's marketing, media buying, public relations, data analytics. And by acquiring IPG just before the holidays, Omnicom essentially swallowed a massive historic competitor to create just an absolute titan.
Which means this is the very first full 90-day quarter since Omnicom closed that blockbuster industry-shaking acquisition.
It's a huge milestone.
We are talking about tens of thousands of employees, thousands of overlapping clients, and billions of dollars in global media spend, all being funneled into a single corporate structure. You do not just smash two of the biggest advertising holding companies on planet Earth together and expect it to be a clean process.
No, you really don't. It is the kind of acquisition that either propels a company to total market dominance, allowing them to basically dictate the terms of the industry, or, it sinks it entirely under the weight of its own administrative bloat.
Yeah, the graveyard of corporate history is packed with companies that bought their biggest rival and then just suffocated on the integration.
Yeah. So the stakes for this Q1 2026 earnings call could not possibly be higher. The street has been waiting for months to see if John Wren, the CEO of Omnicom, and his CFO, Phil Angelastro, could actually prove that this monster they built can run efficiently.
Well, the numbers they dropped give us a very distinct picture of exactly how that integration is going, right down to the decimal point. But as you said, you have to know where to look.
You really do.
Okay, so let's unpack this. I'm going to hit you with the raw data drop straight from the earnings call, and I want to spend some real time digesting what these figures actually mean for you, the retail investor.
Let's hear the numbers.
Okay, so for the first quarter of 2026, Omnicom reported non-GAAP adjusted earnings per share, or EPS, of $1.90.
Which is a solid beat.
Yeah, that is an 11.8% increase compared to the first quarter of 2025. Now, on the revenue side, they reported revenue from what they're calling their core operations at $5.6 billion.
Okay.
And the combined organic revenue growth for this integrated giant was 3.9%.
What's fascinating here is the margin expansion hidden beneath those top-line numbers.
Right, because revenue is just part of the story.
Exactly. Revenue growth is great, obviously, but in a mega merger of this size, what you are really looking for as an analyst is efficiency. Are they actually making more money on every single dollar that comes in the door, or is the new revenue costing them more to manage?
And what's the verdict?
The answer definitively, is that they are getting vastly more efficient. Their adjusted EBITDA margin, which stands for earnings before interest, taxes, depreciation, and amortization, jumped a massive 240 basis points to reach 14.8%.
Hold on, let's make sure we translate that for everyone, because basis points is one of those classic Wall Street terms designed to sound way more complicated than it actually is.
Fair enough, yeah.
When you say it jumped 240 basis points in plain English, that just means the margin increased by 2.4 percentage points.
Correct. It went from a 12.4% margin up to a 14.8% margin.
Now, to someone outside the finance industry, or, someone who invests in tech software where margins are routinely 70% or 80%, a 2.4 percentage point increase doesn't sound like a massive number. 2.5%. That sounds like a rounding error at Apple or Microsoft.
Right. Context is everything.
But in the agency world, that is staggering, isn't it?
It is absolutely staggering. You have to remember the fundamental nature of the advertising and media agency business. It is traditionally a very low margin, highly intensive, service-heavy business.
Because of the people.
Exactly. Your biggest expense, by a massive margin, is human capital. It is people. You are paying salaries for creative directors, media planners, account executives, data analysts. You don't have a software product that you build once and sell 1 million times with zero marginal cost.
Yeah. Every new client requires new humans to service that account.
Right. So the costs scale almost identically with the revenue, historically.
Okay, so breaking that historical trend is a big deal.
It's the historical reality. To expand your margin by 240 basis points in a single year, and not just any year, but the year immediately following a massive complex acquisition, is incredibly rare.
Wow.
It means they are severing that historical link between revenue growth and headcount growth. For you, the retail investor, this adjusted EBITDA margin is arguably the most critical metric in the entire earnings report.
Why that metric specifically? Like, why not just look at the revenue growth or the EPS?
Because it proves the fundamental thesis of the merger. When Omnicom pitched this acquisition to Wall Street, the promise was synergy. It proves that Omnicom is not just getting bigger for the sake of getting bigger.
Right, they aren't just empire building.
Exactly. They aren't just buying IPG to buy revenue and boast about being the biggest holding company in the world. They are actively wringing out costs, consolidating redundancies, and making the combined entity significantly more profitable on a percentage basis than the two companies were when they were operating completely separate from one another.
Okay, I see that. It is the proof in the pudding that the synergies they promised are actually manifesting in the real world, in real dollars.
Yes.
But I want to push back on something here, because this brings us back to that muddy X-ray metaphor we started with. I want to talk about this phrase management kept using on the call: core operations.
Ah, yes. The core operations.
They've reported revenue from core operations at $5.6 billion and organic growth of 3.9%.
Right. They lean heavily on that phrase.
But they specifically excluded a massive chunk of the overall business to get to that number.
Yeah.
On the call, management admitted that as part of their portfolio realignment following the merger, they identified a bunch of businesses they want to sell off or just shut down entirely.
Dispositions, yeah.
And the revenue attached to those disposed businesses or assets that are held for sale is approximately $3.2 billion annually.
It's a huge number.
It is. They already disposed of about $1 billion of that in Q1 alone, like the Jack Morton experiential marketing business they sold. So my analogy here is a student coming home with a report card, but before they show it to their parents, they just take a black marker and cross out their D in chemistry and their F in history, and they say, look, Mom, my core operations GPA is a 3.8.
That's a great analogy.
Are these numbers we are looking at artificially inflated? Like, is management just hiding the ugly, unprofitable parts of the business in this held-for-sale bucket to make themselves look like geniuses?
I get why you'd think that, and it is a totally valid suspicion. It was actually brought up by the analysts on the Q&A portion of the call. Jason Bazinet from Citigroup essentially asked that exact question.
Oh, really? Good for him.
Yeah, he wanted to know why management was focusing the street so heavily on core operations and seemingly ignoring the dragging performance of those disposed businesses, which, by the way, shrank significantly year over year.
Right. If you look at the raw numbers, the disposed businesses shrank drastically. So it really does look like they're just hiding the bad grades to boost the overall GPA.
But that analogy assumes those failed classes still matter to the student's major.
Okay, I'm listening.
A better analogy is a university dropping a defunct, money-losing department entirely, like shutting down an outdated theology program in order to fund a new AI robotics lab. It is a highly necessary, smart business move to separate these numbers.
So it's about shifting focus to the future.
Yes, it absolutely makes the core numbers look prettier. Management is not doing this out of the goodness of their hearts, right? They are acutely aware of the narrative they are selling to Wall Street, but we have to understand why those specific assets are in the held for sale bucket in the first place, and why it's crucial for investors to look at the business this way.
Okay, walk us through that. Why are they dumping $3.2 billion worth of revenue? That is an astonishing amount of money to just walk away from. If they're trying to be the biggest player in the space, why shed that kind of volume?
Because not all revenue is created equal. Revenue without profit is just administrative burden.
That's a good way to put it.
Management explicitly stated that these assets had severely dragging margins. We are talking about margins that are well below 10%, some hovering in the low single digits.
Ouch.
Yeah. Some of these units might even be operating at a net loss once you factor in their overhead. John Wren, the CEO, noted that the initial list of companies held for resale was based primarily on that poor margin performance. But the second, and perhaps more important filter they used when reviewing the combined Omnicom IPG portfolio was asking one simple question: is this necessary for our core clients?
And the answer for these specific units was a resounding no.
Exactly. These are often legacy businesses that made sense a decade ago but have lost their strategic value.
Like what? Give me an example.
Maybe it's a hyper-local field marketing agency in a specific Eastern European country that hasn't grown its top line in 5 years. Or maybe it's a massive physical experiential events company like the Jack Morton agency you mentioned.
Oh, right. Events. That's got to be expensive.
Incredibly expensive, which requires massive overhead, huge physical warehouse spaces, and carries inherently low margins because of the hard costs of building physical event spaces. The CEO bluntly stated that if there was a magic button to just wipe these businesses from their financial statements instantly, he would press it without hesitation.
But there is no magic button in corporate accounting. You can't just delete a business unit.
No, you really cannot. Accounting rules dictate they have to carry them on the books until they are formally sold to a buyer, like a private equity firm or a management buyout, or until they are formally shut down.
Which involves paying heavy severance packages, dealing with complex foreign labor laws if the agency is overseas, breaking long-term commercial real estate leases. It's a messy, incredibly expensive process to take out the corporate trash.
It is painful, and it distorts the financial reality of the company going forward. So by isolating them into a held-for-sale bucket, Omnicom is essentially saying to investors, do not value our future company based on these dying limbs that we are actively amputating. Value us based on the healthy, integrated, surviving body that will actually be here next year.
That makes a lot of sense.
As a retail investor, you actually want this visibility. If they lumped it all together, the impressive 14.8% margin of the core business would be dragged down to maybe 11% or 12%, and you wouldn't be able to see just how well the actual integration of the desirable IPG assets is going.
So it clears the muddy waters.
Exactly. It gives you a much truer picture of what Omnicom will look like 12 to 18 months from now once the garage sale is finally over.
Okay, that makes a lot of sense when you reframe it that way. You want to evaluate the car based on the engine that's going to stay under the hood, not the flat tires that are already sitting on the curb waiting for the garbage truck.
Spot on.
And it is worth noting, they are not hiding the financial impact of taking out that trash. They aren't sweeping the costs under the rug. The CFO, Phil Angelastro, noted in the call that they recorded a direct loss on dispositions of $34 million in Q1 alone and severance and repositioning costs of another $4 million.
Yeah, those numbers are right there on the sheet.
So the pain is absolutely there on the balance sheet. It is just sectioned off on different line items so it doesn't distort the growth trajectory of the main business.
That distinction is crucial. You have to endure short-term pain for long-term margin expansion. And once you clear away the noise of those legacy businesses, you can start to see what is actually driving the growth of that main surviving business. Because the composition of their revenue, how they actually make their money, is undergoing a radical historic transformation.
Okay, here is where it gets really interesting. Because they are squeezing more profit out of every dollar that comes in. But when you look at exactly where those dollars are coming from, it completely shatters the traditional image of what an ad agency actually does.
It really does.
I was reading through the transcript of the call, and there was a detail that genuinely shocked me. Omnicom is historically one of the most famous advertising agencies in the world. They are the descendants of the Mad Men era. They literally define the industry.
The absolute pioneers.
Right.
Yeah.
But in Q1 2026, their revenue from traditional advertising actually went down. Let me repeat that. The advertising revenue for the biggest advertising conglomerate on earth declined in the first quarter. Yet their total core revenue grew by nearly 4%.
Crazy, right?
How on earth is that possible?
It's possible because advertising, in the traditional sense of the word, making a 30-second television commercial, designing a clever billboard, writing a catchy jingle for a radio spot, is rapidly becoming a minority component of what these massive holding companies actually do for their clients.
Wait, really? A minority component?
Yes. The real growth, the absolute juggernaut carrying this entire company forward and offsetting those traditional declines, is what they categorize as integrated media.
Integrated media. Okay, it sounds like classic corporate buzzword bingo. It sounds like something a consultant makes up to charge a higher hourly rate.
It does sound like that, I'll admit.
Break that down for us. What is it in the real world and how much of the pie does it represent?
The scale of it is what's truly shocking. In Q1 2026, integrated media made up a staggering 52% of Omnicom's core revenue.
Wow.
More than half of their entire global business is now this one discipline. And while traditional advertising was shrinking, integrated media was growing in the high single digits.
So it is pulling the entire massive weight of the company upward all by itself. If integrated media sneezes, the whole company catches a cold.
Yes, exactly. And to define it without the buzzwords, integrated media is the combination of media planning and buying, meaning the rigorous mathematical process of figuring out exactly where to place ads and purchasing that digital or physical real estate combined with commerce integration, massive data analytics, and digital media execution.
So it's the math, not the art.
Precisely. It is the plumbing, the targeting, the algorithms, and the mathematics of marketing, rather than just the art of the creative idea.
Okay, let me try an analogy here to see if I am grasping the shift. If traditional advertising is Don Draper in a tailored suit, sketching a clever slogan on a napkin while drinking a martini,
Classic image.
then integrated media is a windowless room full of data scientists, statisticians, and algorithms, ensuring that a highly personalized, dynamic version of that slogan reaches exactly the right consumer at the exact millisecond they are most likely to click buy on their smartphone.
That is a phenomenal way to visualize it. The creative napkin still exists, but it's no longer the profit center. The room full of data scientists is where the real value is generated.
It's a huge shift in the business model.
It is. And the reason this specific discipline is growing so incredibly fast is due to a massive structural shift in client behavior. On the call, John Wren highlighted that clients are actively, aggressively consolidating their marketing needs.
What do you mean by consolidating?
Well, 10 years ago, a brand would hire one boutique agency for creative, a different massive agency to buy their TV spots, a specialized third agency to handle their social media data, and a fourth consulting firm to run their retail commerce strategy.
Right. They wanted a specialized expert for every single channel.
But that created a nightmare of disconnected data and competing agency egos. Today, they want a single massive partner who can do it all seamlessly under one roof.
And he named names on the call. He specifically called out major global brands like Clorox, Dyson, Delta, Exxon, Kroger, Merck, and Unilever.
Heavy hitters.
These are not small experimental accounts. These are multi-billion-dollar global brands with massive marketing budgets. And they're bringing all their toys to Omnicom's integrated sandbox.
They are doing that because Omnicom now has the sheer unprecedented scale, especially after acquiring IPG to handle that level of global complexity.
So scale is the key.
Scale is part of it, but scale alone isn't enough anymore. You can't just have 100,000 employees. You have to have the technological infrastructure to process all of that integrated data across 100 different countries in real time.
Right.
And that is where the earnings call ventured into some incredibly dense, almost futuristic territory regarding artificial intelligence.
Oh, absolutely. The AI jargon was flying fast and heavy, even for an earnings call. Management was throwing around terms like agentic AI and the HCP protocol.
He was thick.
It sounded more like a Silicon Valley tech symposium than a Madison Avenue advertising earnings call.
Yeah.
As a retail investor, when I hear terms like agentic AI, my eyes start to glaze over a bit.
It happens to the best of us.
It feels like they're just sprinkling AI buzzwords on the call to pump the stock price. Can we translate this into plain language? What are they actually doing with AI? And more importantly, how does it make them money?
It's very easy to dismiss it as buzzword bingo, but in this specific case, it is actually a fascinating and highly disruptive technological leap that explains their margin expansion.
Okay, I'm intrigued.
Let's start with their core AI platform, which they call Omni. Omnicom has invested heavily over the last decade in Omni as their central intelligence operating system. It connects all their talent, all their data, and all their services globally.
Like a central brain for the company.
Yes. In Q1, they rolled out the next generation of this platform to all their employees. But the real magic word they use, the one that signals a massive shift, is agentic.
Agentic, like a secret agent or a real estate agent.
Closer to a real estate agent, actually.
Yeah.
In the world of artificial intelligence, an agent or agentic AI refers to a system that doesn't just passively answer a prompt. When you or I use ChatGPT, we type a prompt, it writes a poem or a summary, and it stops. It waits for us.
Right, it's reactive.
Exactly. An agentic AI actively takes autonomous actions to achieve a predefined goal. It acts as an agent on your behalf out in the digital world.
Okay, so how does an autonomous AI bot actually work in the context of buying media for a brand like Delta or Exxon?
To understand why this is revolutionary, you have to understand how broken the current system is. Right now, the digital advertising ecosystem is what John Wren accurately called a messy middle.
Messy middle.
Yeah. If a client, say Exxon, wants to buy ad space on a publisher's website, like the New York Times, they don't just call the New York Times anymore. There are dozens of technological intermediaries sitting between the advertiser and the publisher.
A whole chain of middlemen.
Exactly. You have demand-side platforms, or DSPs. You have supply-side platforms, SSPs. You have ad exchanges, data brokers, verification partners. It is a highly complex, fragmented supply chain. And crucially, every single one of those middlemen takes a toll.
They all get a cut.
They take a slice of the client's working media dollar.
So a client spends $1 thinking they're buying $1 worth of ad space, but maybe only 60 cents actually goes to the publisher because the DSP, the SSP, and the data broker ate 40 cents in transaction fees.
That is the exact reality of the programmatic advertising industry today. It is incredibly inefficient. What Omnicom is doing with their agentic AI and this new ADCP protocol, which stands for Advertising Agent-to-Agent Communication Protocol, essentially a new framework for how these AI agents talk to each other, is revolutionary.
What are they doing with it?
They are using their AI bots to negotiate, bid, and buy media inventory directly from the publisher's bots. Agent-to-agent buying with zero human intervention and, more importantly, zero traditional tech middlemen.
Whoa. So they are just bypassing the ad exchanges and the demand-side platforms entirely. They are cutting the Google ad exchanges and the trade desks of the world out of the loop.
They are actively laying the pipes to do exactly that. They noted on the call that they have already executed real live media buys for several clients using this agent-to-agent framework in Q1.
That's huge.
By cutting out the messy middlemen, they drastically shorten the supply chain. This means more of the client's dollar goes to actually buying ads, which makes a client's campaign perform better.
And the publisher is happy too.
Exactly. It makes the publisher happier because they get a larger share of the dollar. And critically, it positions Omnicom as the ultimate, irreplaceable technological toll booth. They are replacing the old tech middlemen with their own proprietary AI.
This brings up a massive conceptual shift. I want to float an analogy here and push back on the traditional idea of what an ad agency even is in 2026.
Let's hear it.
Think of a modern marketing campaign like a guided missile. For the last 100 years since the dawn of modern advertising, agencies competed almost entirely on having the most explosive, most impactful warhead, the creative idea, the best commercial, the funniest joke, the most emotional story. That was the explosive payload.
Absolutely.
But looking at these numbers, looking at the decline in traditional advertising, and looking at this massive AI infrastructure, is Omnicom essentially admitting that having the best targeting system is now far more profitable and far more important than having the biggest explosion?
You're touching on the exact fulcrum of the industry's transformation. The payload still matters, of course. A terrible ad won't sell a product. But if you drop a massive, brilliant explosive in the middle of the empty ocean, it is completely useless. The economic value has shifted dramatically to the targeting system. And to understand just how powerful Omnicom's targeting system is, why they can confidently deploy these AI agents to buy media, we have to talk about the crown jewel of this entire IPG acquisition. We have to talk about Acxiom.
Yes, Acxiom. This was a major point of discussion and honestly, a bit of friendly tension. during the Q&A segment with the analysts. Tell us exactly what Axiom is and how it fits into this guided missile targeting system.
Axiom is one of the world's largest, most sophisticated consumer data brokers. They hold incredibly detailed demographic, financial, behavioral, and transactional data on hundreds of millions of consumers globally.
They know everything about everyone.
Pretty much. If you have ever bought a house, used a credit card, or registered a vehicle, Axiom likely has a file on you. Now, here is the historical context that makes this so fascinating for an investor. Interpublic, IPG, bought Axiom back in 2018 for roughly $2 billion.
And Omnicom just bought the entirety of IPG for $9 billion. So Omnicom basically got Axiom thrown into the bundle.
They inherited it, yes. And during the earnings call, an analyst actually teased John Wren about this history. The analyst noted that back in 2018, when IPG bought Axiom, Wren had publicly criticized the strategy.
Oh, really?
Yeah. He essentially mocked IPG, saying it wasn't the right time for an agency to own a data broker, that it was a distraction. And now, fast forward to 2026, Axiom is being cited by Wren himself as a primary driver of Omnicom's future momentum.
Wren had a pretty good comeback for that on the call, didn't he? He didn't just take the punch.
He didn't. He essentially joked that his waiting strategy paid off brilliantly. He pointed out that IPG paid $2 billion just for Axiom in 2018, and he waited a few years and bought the entirety of IPG, including Axiom and dozens of other world-class agencies for $9 billion, getting a vastly superior economic deal.
That's a great spin.
It is. But jokes aside, Wren admitted something very important. He admitted that while Omnicom might not have had the technological capability to utilize Axiom's massive data lakes back in 2018, they are absolutely perfectly positioned to weaponize it now.
What changed? Why is that consumer data so much more valuable today than it was in 2018? Is it just because they have the Omni platform now?
It is two massive converging trends. First, the deprecation of the third-party cookie. For 20 years, the entire digital advertising ecosystem relied on tracking people via third-party cookies as they surfed the web.
Right, the cookies.
But privacy laws like GDPR in Europe and tech companies like Apple and Google restricting tracking on their devices and browsers have largely killed the cookie. So having massive amounts of first-party data that you actually own, manage, and verify directly, which Axiom provides, is suddenly worth its weight in gold.
It's a massive competitive advantage.
It has immense fidelity. Furthermore, Axiom works heavily in highly regulated industries like finance, automotive, and pharma. This means the data has to be fiercely accurate and compliant with strict privacy laws. It isn't just scraped junk data, it is pristine.
And what is the second trend that makes it so valuable now?
Artificial intelligence.
Huh?
As Omnicom's head of AI, Paolo, pointed out on the call, the sheer proliferation of generative and agentic AI means they can now ingest that massive mountain of Axiom data and actually drive actionable value from it instantly.
Instant.
Yeah. Before, it would take teams of human data scientists weeks to segment an audience, pull a list, and build a media plan. Now, the Omni AI can look at the Axiom data, instantly identify the absolute perfect consumer profile for a specific product, and deploy those agentic bots we talked about to go buy the media space in front of that exact consumer in milliseconds.
Wow. So the creative advertising might be down, but the integrated media, powered by pristine Axiom data and executed by autonomous AI bots, is printing money.
Printing money.
It requires fewer humans, it cuts out the tech middlemen, and it delivers better results for the client. That perfectly logically explains the 240 basis point margin expansion.
It's the whole engine.
But there's another massive engine driving that $1.90 EPS beat, and it has absolutely nothing to do with advertising, AI, or data.
Ah, yes.
It is pure, ruthless financial engineering. We need to talk about the share buyback program.
We absolutely do. Because while AI and data are the operational story, for a retail investor looking at the actual stock price ticker, this financial engineering is a monumental factor. In the first quarter alone, Omnicom repurchased a staggering $2.8 billion of its own stock.
$2.8 billion in 90 days. That is an astonishingly aggressive deployment of capital.
Extremely aggressive. A large portion of that was executed through an accelerated share repurchase program, or an ASR. By executing this ASR, they retired over 28 million shares from the open market in a single quarter.
Let's make sure the listener fully grasps the mechanics of why this matters so much to the EPS number, because it is the oldest magic trick in Wall Street's book, but it works every time.
It never fails.
Earnings per share is exactly what it sounds like. You take the total earnings, the net profit of the company, and you divide it by the total number of shares that exist in the market. So if you aggressively shrink the denominator, if you take 28 million shares and literally throw them in the corporate incinerator so they no longer exist, every single remaining share is suddenly entitled to a larger piece of the profit pie.
That's the mathematical reality. The earnings per share goes up, even if the actual net income of the company stayed perfectly flat. It is a mathematical certainty.
Give us an analogy.
If a pizza is cut into 10 slices and I take 2 slices and throw them away, the remaining 8 slices represent a larger percentage of the total pizza. Management is projecting that by the end of 2026, through these continued buybacks, they will have reduced the total outstanding share count of the company by approximately 11% to 12% compared to where it was at the end of 2025.
That is massive. That means if you, the listener, hold a share of Omnicom right now, your actual ownership stake in the company, your claim on their future cash flows, is increasing by over 10% this year without you having to buy a single additional share or spend a single extra dime.
And they aren't stopping. They have a total authorization from their board to repurchase up to $5 billion worth of stock over the next 12 months. This buyback engine is a massive foundational pillar supporting that double-digit EPS growth they reported. It is a classic textbook holding company playbook, but they are executing it on a massive, unprecedented post-merger scale.
Okay, so that covers the present. We know Q1 was a beast. But let's look ahead to the rest of the year and beyond. When the analysts asked management to look into their crystal ball for the rest of 2026, what were the promises being made? Because the street doesn't price a stock based on what you did yesterday. It prices it on what you promised to do tomorrow.
Right. Management is projecting significant, almost aggressive confidence. Despite the massive ongoing undertaking of integrating IPG, which, again, is thousands of employees and dozens of agencies, they are maintaining their target of 4% organic growth for the core operations for the full year.
4% organic growth.
Furthermore, they are projecting double-digit EPS growth for the full year. In fact, when pressed by an analyst on the call, John Wren indicated that the EPS growth in the upcoming quarters would likely be even higher than the 11.8% they just saw in Q1.
Wow. So they expect the financial momentum to actually accelerate as the year goes on. How do they plan to achieve that operationally? Obviously, the share buybacks are a big part of the math, but operationally, how do you wring that much more profit out of a freshly emerged behemoth while the dust is still settling?
It comes down to the magic word in every single corporate merger in history: synergies. Specifically, massive, ruthless cost reduction synergies. Management stated they are currently on track to cut $900 million in costs from the combined business in 2026 alone.
$900 million.
And they expect those cuts to scale up to $1.5 billion in annual savings by mid-2028.
$900 million in savings in a single year. You don't find that kind of money just by switching to cheaper coffee in the break room or cutting back on client dinners. Where are these massive cuts actually coming from?
They outlined several specific major operational moves. First, what they call hub building locations. Historically, holding companies would acquire dozens of different boutique agencies, and every single one of those agencies would maintain its own fancy office lease.
Right, the real estate footprint.
You'd have 5 different Omnicom agencies and 4 different IPG agencies, all with separate, expensive offices in New York, London, or Tokyo. Omnicom is aggressively breaking those leases and consolidating these physical footprints, moving multiple agencies into shared, centralized hub buildings.
So everyone under one roof.
The commercial real estate savings alone, especially in premium markets like Manhattan, are astronomical.
Right, because you don't need 5 different expensive lobbies, 5 different reception desks, and 5 different IT server rooms in Manhattan when one centralized hub will do the exact same job.
Precisely. Second, they are deploying common HR and IT platforms across the entire global network. When you buy a company like IPG, you inherit their entire back office infrastructure.
All the systems.
You have redundant payroll systems, redundant software enterprise licenses, redundant procurement teams, and critically redundant middle management overseeing those systems. By migrating everyone to shared, unified workflow systems, bringing IPG onto Omnicom's tech stack, you eliminate massive amounts of duplicated administrative bloat.
It is brutal for the people in those redundant middle management roles, no doubt about it.
Yeah.
The human cost of a merger like this is very real. But for the shareholder, it is pure, unadulterated margin expansion.
Exactly.
But I have a major pushback here. I see a giant glaring red flag on the balance sheet that we need to address before we get too euphoric about this stock.
Let's address it.
You cannot buy a $9 billion company without financing it. It wasn't an all-cash deal. To buy IPG, Omnicom assumed $3 billion of IPG's existing debt. On top of that, in Q1, Omnicom issued another $2.3 billion in brand new senior notes just to fund things like these massive share buybacks, the severance packages, and the integration costs.
You're right on the numbers. They issued $1.7 billion in US dollar-denominated notes at a 4.9% interest rate and another $600 million in euro-denominated notes at 3.85%.
So their gross long-term debt is now sitting at a towering $10.2 billion. And the CFO, Phil Angelastro, admitted plainly on the call that their net interest expense, the amount of money they have to pay just to service their massive debt pile, is going to spike by approximately $200 million this year alone compared to last year.
That is a significant spike.
So my question is this. With debt piling up to over $10 billion and interest expenses spiking by hundreds of millions of dollars, is this massive $5 billion share buyback strategy actually reckless? Are they essentially taking out a massive second mortgage on the house just to throw a party for the shareholders today while risking the long-term structural health of the company?
That's a very fair concern.
What happens if there is a recession next year and advertising budgets dry up, but they still have a $10 billion debt anchor around their neck?
It is the most vital question a skeptical investor should ask. Taking on debt to buy back stock can absolutely be a toxic, value-destroying spiral if a company's underlying business is deteriorating or cyclical. But if we connect this to the bigger picture and look at the cash flow statement alongside the balance sheet, the narrative changes entirely. You are looking at the gross debt number in isolation, which is scary, but you have to look at their ability to service it.
Okay, connect the dots for me. Walk me back from the ledge. Why isn't this $10 billion debt pile a ticking time bomb waiting to blow up the company?
Because of the sheer overwhelming velocity of the cash this combined entity generates on a daily basis. Look at their free cash flow. In Q1, their free cash flow was up 70% year over year.
70%.
Yes. Part of that is simply because they added IPG's cash flow to their own, but it also reflects improved performance and higher margins in the underlying business. This company, especially with the AI driving efficiencies, is a cash printing machine.
And just to clarify for everyone, free cash flow is the money left over after the company has paid all its operating expenses, all its salaries, and all its capital expenditures. It is the true, unmanipulated lifeblood of a business. It is cash they can actually use to pay down debt or return to shareholders.
Exactly. And let's look at their liquidity profile right now. Even after buying IPG, and even after spending $2.8 billion on share buybacks in Q1 alone, they still have $4.3 billion in cash and cash equivalents sitting on their balance sheet right now.
That's a massive cushion.
It is. Plus, they have a completely undrawn $3.5 billion revolving credit facility. They are swimming in liquidity. They are not cash-strapped in any sense of the word.
So they have the cash on hand to service the daily interest payments on the debt. But what about when the principal actually comes due? If you have a massive billion-dollar balloon payment due in a high-interest rate environment and the credit markets freeze up, that can crush a company instantly.
The CFO addressed this exact risk directly by highlighting their debt maturity schedule. They do not have any significant debt maturing until July of 2027.
So they have time.
They have a completely clear runway for the next year and a half to just focus on integration and cash generation. And if you look at their leverage ratio, which calculates their total debt relative to their pro forma adjusted EBITDA, essentially measuring how many years of profit it would take to pay off their debt, it sits at a very manageable 2.5 times.
2.5 times.
In the corporate finance world, especially for a holding company with highly predictable, massive diversified free cash flow across thousands of clients, a 2.5x leverage ratio is considered very healthy and reasonably conservative.
Okay, so to answer my own question, it isn't reckless. The math actually works perfectly in their favor. If the cost of the new debt they issued is around 4.9% for the U.S. notes, but the earnings yield on the shares they're buying back is significantly higher than that, and their internal hurdle rate for returns is higher than that, then borrowing money to retire stock is actually a mathematically sound, highly accretive strategy.
You got it, exactly.
Management is looking at their massive cash generation, looking at their 2.5x leverage, and realizing the best possible return on investment they can make right now is simply betting on themselves and rewarding the shareholders immediately.
I wouldn't call it risk-free because no debt is risk-free, but it is highly calculated and mathematically sound. They have rigorously modeled out the cash flows. They know with high certainty that the $900 million in cost synergies will drop straight to the bottom line, and they are using their balance sheet aggressively but safely to maximize shareholder value while the stock is arguably undervalued given the new scale of the company.
Which brings us to the ultimate question. We have waded through the muddy waters of the merger. We have looked at the debt profile, the shift from creative to AI, the margin expansion, and the aggressive cost synergies. I need you to take a firm, opinionated stance for the retail investor listening right now. When you look at Omnicom's Q1 2026 earnings call in totality, is this a bullish or a bearish signal?
It is a heavily, undeniably bullish quarter.
No hesitation at all. You are fully bought in.
I am. Look, as we said at the top, mega mergers fail all the time. The default assumption when two giants merge should be skepticism. But what this Q1 report proves with hard data is that Omnicom is defying that gravity. The integration of IPG is moving at lightning speed.
Faster than anyone expected.
They haven't just talked about synergies, they have actually executed them. They have already centralized teams, consolidated massive real estate portfolios, and achieved a 240 basis point margin expansion in the very first quarter out of the gate. That is phenomenal textbook execution by John Wren and his management team.
The proof is in the margin expansion. It is undeniable.
Furthermore, their strategic long-term pivot is working perfectly. They are not fighting the secular decline of traditional advertising. They are leaning heavily into the future.
Right.
By focusing on high-margin integrated media, weaponizing the Axiom data they inherited, and deploying agentic AI to literally cut out the tech middlemen in programmatic ad buying, they are positioning themselves not just as an ad agency, but as an indispensable technological infrastructure provider for the world's biggest brands. And the immediate results, winning massive consolidated global accounts from clients like Delta and Clorox, validates that strategy in real time.
So speak directly to the listener right now. If you are a retail investor holding OMC stock in your portfolio, or if you are sitting on the sidelines considering initiating a position, what does this specific earnings report mean for you fundamentally?
It means you have a remarkably strong, mathematically reinforced floor beneath your investment. The combination of the aggressive cost-cutting synergies, which remember will continue to ramp up from $900 million this year to $1.5 billion by 2028, and the relentless, massive share buyback program creates a massive tailwind for the stock price.
So even if the economy softens,
if management executes their stated plan to reduce the total share count by 11% to 12% by the end of this year, their earnings per share is going to grow significantly, almost by default, even if the macro advertising environment softens.
are there any short-term risks the retail investor needs to be aware of? What could cause a hiccup in the stock price over the next 6 months?
The only real short-term risk is the messy accounting we discussed at the very beginning. The process of selling off that $3.2 billion bucket of non-core assets, the legacy field marketing, the experiential businesses, the low-margin foreign agencies, is going to create some very noisy quarters.
The garage sale.
The garage sale, exactly. You might see accounting losses on dispositions, heavy severance charges popping up on the income statement, and fluctuating top-line reported revenue numbers as those assets officially fall off the books. It could cause some algorithmic trading volatility if a headline number looks funky or misses an estimate because of a disposition timing issue.
But the actionable advice is to completely ignore that noise.
Completely. Ignore the noise of the dispositions. They are a feature, not a bug of the transition.
Yeah.
Solely at the core operations. The core engine of this newly integrated behemoth is expanding its margins, growing organically by nearly 4%, and printing free cash flow at a 70% higher rate than last year. If you own the stock, you hold it. You let the management team do the hard, dirty work of cutting costs and breaking leases, and you let the $5 billion buyback program work its mathematical magic on your shares.
That is a definitive, actionable verdict. Hold the line, let the buybacks bake into the EPS, and watch the core margins expand as the AI and data take over. We want to thank you for joining us on this massive, supersized deep dive into Omnicom's Q1 results. We started by looking at a murky X-ray, but I think we've successfully brought the picture into focus. We've established that proprietary data, autonomous AI execution, and ruthless operational efficiency are currently winning the day and heavily outperforming the traditional reliance on clever creative advertising.
But this raises an important question, and it is a structural, existential question for the entire marketing and media industry going forward.
I love it. Leave us with one final thread to pull on.
We spent a lot of time talking about Omnicom's new agentic AI. We talked about their autonomous bots executing agent-to-agent media buying, seamlessly connecting the pristine Axiom data to the digital publisher, completely bypassing the human media planners and the traditional tech middlemen like DSPs and ad exchanges.
Right.
And we noted that traditional advertising revenue, the actual creation of the ads, is actively shrinking while this integrated tech revenue explodes.
The guided missile analogy. The payload versus the targeting system.
So the question to ponder is this. Are we currently witnessing the final, irreversible death of the Mad Men creative agency? If the economic value has entirely shifted to first-party data and autonomous AI execution algorithms, will Omnicom even be considered an advertising agency 5 years from now?
That is a big question.
Or will they have fully metamorphosed into a pure technology and data middleman, competing more with Google, Amazon, and Palantir than with other creative ad boutiques?
That is a genuinely chilling thought for a copywriter or an art director, but an absolutely fascinating one for an investor. We started this deep dive talking about how an earnings call is usually a clean X-ray, but a mega merger turns it into muddy waters. Well, the waters are finally clearing, but the X-ray is showing us an entirely different species of company than the one we thought we were looking at. It is no longer an agency built on human intuition, focus groups, and creative flair. It is a machine built on proprietary data, algorithmic execution, and ruthless financial efficiency. And right now, that machine is operating flawlessly. Something for you to mull over until our next deep dive.